The S&P 500 index has corrected by 3%. Now, that may not sound like much, but this is the largest two-day decline on the US stock market since April. We've had a relentless rise in US stocks over the last few months, and they're now taking a breather. We've been very vocal about the risk of this kind of correction occurring over the last few weeks. In early July, we highlighted that the stock market was likely overextended, and we cut out the vast majority of our exposure to US stocks, sending sell alerts to many of the trades that we had at the time. Fast forward a month later, and the situation has evolved significantly. As I'm going to show you in this video, we think this correction is a buying opportunity heading into the end of the year. We've already been taking advantage of it with our clients at bravosresearch.com. About a month ago, we showed this chart in one of our videos. It told us that professional fund managers had a 99% exposure rate to the US stock market. We explained why this brought about a significant risk that these fund managers would end up rebalancing their exposure to more normal levels, and that this could trigger a pullback. This seems to be what has happened, as fund managers have indeed reduced their exposure along with a correction in stocks. Now, we've seen quite a few of these types of corrections over the last few years, where a rebalancing of fund manager exposure triggers volatility on the broad US stock market. While these are very often painful and quite violent, they're not always a symptom of real underlying economic weakness. Stocks do not go up in a straight line. Bull markets tend to stair-step upwards, and these kinds of temporary pullbacks are 100% healthy. We think that's what's happening right now. If we look at S&P 500 earnings per share and zoom in closer to see what they've been doing more recently, we understand why the stock market has been so strong since April. Corporate America has been thriving throughout 2025. Profits remained resilient despite the uncertainty around Donald Trump's tariffs, and they've even been accelerating higher over the last few months. And we think there's a very good reason for why this could continue. Firstly, the US dollar index has been declining significantly throughout 2025. This has been one of the largest moves down in the US dollar of the last decade, and as we've been highlighting in recent episodes, we think there's room for it to continue moving lower. A weak US dollar mechanically puts upwards pressure on the S&P 500 index and on stock market earnings that are both priced in US dollar terms. At the same time as this is happening, we have interest rates that are declining in the United States. In fact, since 2023, short-term interest rates like the 2-year yield have been on a steady decline. Lower interest rates means lower borrowing costs, and also provides what's called a lower discount rate. And both of these things push investors to purchase riskier assets like stocks. And as if all of that wasn't enough, we also have oil prices that have continued to trend lower over the last few months. Lower energy prices allows the consumer to keep his head above the water and keep the economy resilient. A lower dollar, lower interest rates, low oil prices, these are all what we call loose financial conditions. And looking back through history, it is very rare not to see stocks move higher when we see all three of these conditions. Now, our first principle at Bravos Research is that we acknowledge that we don't know what the future holds. This is something that we've learned the hard way. It is foolish for anyone to suppose that they know exactly what is going to happen in the future. Luckily, we don't need to do that in order to be profitable traders. In fact, quite the opposite. If you acknowledge the fact that you don't know what the future holds, you're going to be a lot more effective at managing your risk or cutting your losses when you make big bets on the market. So this first principle is what allows us to be extremely aggressive risk takers in the market and make big bets. When things go our way, we win big, and when they don't, we cut our losses quickly. This is the foundation of what it takes to be profitable in trading. I made a video on this that takes you through all of these essential concepts that are required for profitable trading in detail that I'll leave in the description down below. If you're serious about trading the market, make sure you go watch it, because that will allow you to truly make big winning bets on the market. Right now, our big bet is that the US stock market will continue to move higher, and although August and September are seasonally weak months, which could mean we see a bit more volatility in the short term, generally we'll be using any volatility in the coming weeks to continue increasing our exposure to stocks. And as I mentioned earlier, we've already begun to ramp up our exposure. We increased our stake in cryptocurrencies that now represent roughly 15% of our portfolio portfolio. We also initiated a position on Google and on a stock called Yalla Group that we think are all stocks that could have significant more upside in the coming weeks. But even though we are optimistic on the stock market today, we think there's an even bigger opportunity in the market right now, and that is on precious metals. We have roughly 20% of our portfolio currently exposed to this trade right now, and we may be ramping that up even further. Let me explain why. The US government just posted its 2 weakest job reports since the pandemic. This is a report called the Non-Farm Payroll Report, and it shows us how much the labor market is growing each month. And we've just witnessed the US job market go from one of the hottest in history back in 2021 and 2022 to now pretty much grinding to a halt, with the economy pretty much not adding jobs anymore. The reason this is so important is because it brings us a lot closer to the tipping point where job growth could go negative, which effectively would mean that the economy is losing jobs, which is what happens during economic contractions. The last 3 times we saw a sustained contraction in the labor market were in 2020, 2008, and 2001. If we look at what happened to the US stock market in all of these instances, it experienced pretty violent declines, 30, 50, 60% drawdowns. Now, the reason we don't believe that this is an imminent danger is because of the loose financial conditions that we discussed earlier in the video. But it does show us that the economy is vulnerable today. If financial conditions were to reverse, for example, if oil prices were to spike, or an asset bubble were to pop, that could take the labor market past the tipping point and into contraction. It's entirely possible that we see that happen next year. This is why, although we are ramping up our exposure to US stocks, we're even more aggressive on gold. We currently have 3 active trades on precious metals, including 2 gold miners that we think have a lot of upside potential heading into the end of the year and potentially beyond that. It's very possible that we increase our exposure further to precious metals in the coming weeks. The video linked in the description down below explains the principles that allows us to make these kinds of big bets on the market with extreme confidence and very little stress. Make sure you don't miss it. Subscribe to stay updated on the market. Thanks for watching.